Next price increase for the courses is June 1, 11:59 p.m. Check the link down below. Real estate investing, stock investing, and of course, making more money as an employee or entrepreneur with those AI lectures coming out soon to catch you up to speed with everything you need to know about how to be more productive and make more money using artificial intelligence. I just can't take it anymore. It seems like non-stop, and I don't know, correct me if I'm wrong here, okay? But it just seems like for the last 3 weeks, all the news stations could talk about every single day is the debt ceiling. I feel like we've been around the block long enough to know that the debt ceiling was going to get passed. We said this with people ask me, but Kevin, it seems like we're getting closer to default this time. Or I mean, even course members were asking me, and I get it because it's all over the news. It's just constant debt ceiling, and I'm like, we're raising the debt ceiling. It's going to happen. It's going to be dramatic, but it's going to happen. And people are like, well, what odds would you assign to it? Come on. And I'm like, fine. 99.9% chance it's going to get raised. But there's just going to be a lot of drama between now and then. And it's just so exhausting because I think the last 3 weeks, every single time you turn on the news, whether it's Fox or CNN or it's CNBC or it's Bloomberg, it's nonstop. It's just debt ceiling. The United States has never defaulted. This is the first time we're going to default. We're going to do a Great Depression. There's going to be so much joblessness, and the Fed can't save us. And it's the same crap over and over again. Honestly, I think I've become convinced that the mainstream media is driven by nothing other than, okay, what is the next big fear catalyst? And okay, fair. Like, to some extent, especially if we're trading, we want to know what the next fear catalysts are. And we can go through some of those fear catalysts right now. But really, the exhausting nature of just this incessant fear over nothing drives me nuts. I'm a big fan of like real catalysts. Like, give me some actual real fear. And for me, I actually agree with this survey that was done over the weekend over, okay, what are the realistic next levels or rather the next fear catalyst that we should actually care about? Like, what are things we should care about? And the biggest response in the survey came from, a potential reignition, and this is a reasonable one, of inflation. And I thought, okay, well, finally, like this is actually like a reasonable point of view because nobody really expects that the next fear catalyst is going to be the actual debt ceiling, because at this point, this is over. So 41% of respondents were convinced that the next fear catalyst is inflation. And maybe not necessarily that we would end up getting a reignition of inflation, but that 41% of people believe the biggest worry the market should have is inflation. And that's fair, because quite frankly, if we do get a reignition of inflation, then we do actually have problems to worry about. Now we've got more to fall in the stock market because it's rallied more. We have the potential risk of being Paul Volckered. We have the de-anchoring of inflation expectations. And by far, I agree that probably the biggest risk to markets going forward is inflation. Now, that's remarkable because there's really scant evidence of reigniting inflation. Natural gas prices in Europe, for example, are at the lowest level they've been since right before the invasion of Ukraine. It's insanely low. You've got shorts piling up on OPEC, basically on oil, and OPEC's like, you better not start shorting because we're going to cut production. Meanwhile, they're talking about cutting production, but so far we haven't gotten an announcement on cutting production. So in other words, they're just trying to like manipulate the market. Of course, that's just what they do. You've got that many people worried about inflation, and then the next big fear was recession. And this idea with recession is that, okay, well, all right, fine, but here's the thing, Kevin. Liquidity is going to kill the market. That was the next big fear catalyst that a lot of people were driving. And this idea is, okay, well, here's what's going to happen. The Treasury Department is going to have to reissue bonds as they kind of run off, and then the markets might have to absorb these, and we're going to see all of this happening at the same time as you see quantitative tightening, and that's just going to suck all this money out of the economy, and then the economy is going to collapse. This is sort of the second like bear thesis. So one bear thesis is, okay, well, inflation. And then the second bear thesis is recession and a liquidity crunch. What's crazy is, first of all, nobody really knows what's actually going to happen, but the odds are things are probably not going to be as bad as feared. And a lot of the sort of more moderate people who are just trying to understand the economy rather than like push either a bull or bear narrative, a lot of folks are looking at the reverse repo facility and saying this is probably the best speed governor we have to suggest that even in a quantitative tightening scenario, we don't necessarily have to be that horribly worried about what's going to end up happening with liquidity, because quite frankly, we've got plenty of it. This right here on screen is the amount of money sitting in the reverse repo facility. Now this gets a little confusing. Usually when I mention this, I feel like people shut down. And I think there's a very easy way to explain this. And think about it like this, okay? If you were a bank, let's say you're a bank, and you're responsible for holding on to $1 million, let's just say, and you have a choice. You could take that $1 million and you could lock it up into 6 month or 1 year or 5 year or 10-year treasury notes, and you could lock that money up, and then you could earn, let's say, 4% on that money, but you have a lockup, right? This is your choice. You earn 4%, maybe you even earn 5% on your money, but you have to lock up your cash. Okay, remember, you're the banker now. Well, what risk could that pose if you lock up some of your cash as a banker? Well, we just all learned that in the last 2 months. You could suffer a bank run and then go bankrupt, right? Interesting where the phrases came from. So then you have this other option, like, well, if I have $1 million, you could just take that money. And what if I told you this? Instead of locking it up for 6 months plus, you could lock it up overnight. Oh, well, how much are you going to pay me to lock it up overnight instead of longer term? What if I told you you could actually earn the Fed rate of 5%? Obviously, on a banker's year divided by 360 days, so you're just going to earn 1/360th of 5%, but you'll earn it every single night, which is the same as really holding treasuries, because you're also earning interest. Essentially, you're accruing interest on a daily basis. So where would you rather put the $1 million? Well, obviously, if you're a banker, to some extent, you're having some money in treasuries because they all do. But to the extent that you're allowed to, because there's a limit here, you're going to put as much freaking money as you can right here in this overnight facility. And this overnight facility is this. It's the reverse repo facility. And that reverse repo facility is sitting here with lots of money. Over 2.1, nearly $2.2 trillion. That's a lot of money. And so what I'm finding is that the more neutral individuals who aren't trying to push a bear narrative or a bull narrative, they're saying, look, yes, we are going to go through a massive phase of quantitative tightening. But what you have to consider is the Federal Reserve is just allowing treasury bills and bonds to expire at the rate of $80 billion per month. Now, that's fascinating because the reverse repo facility itself, during the beginning, during this first year and 2 months of quantitative tightening that we've already gone through, because this started in March of 2022, we've already been at this now for 14 months, it's basically stayed stable, which is insane because a lot of people look at this as basically a parachute. And they say, okay, well, if you could take 2.1 and divide it by $80 billion per month, well, how many months do you have? You have 2 years. You have about 26 months of money sitting right there. So in other words, if all of the money the Federal Reserve tightened on a monthly basis simply led banks to basically replenish those treasuries, and that's going to happen as rates start falling, Now all of a sudden you could actually delay the effects of quantitative tightening for another 2 years, which is insane. But again, generally to make this happen, you're going to start seeing interest rates come down. And this is why, because now you're seeing that overnight rate go down, and there's more of an incentive on treasuries. Long and short of it, there's this massive buffer against this liquidity fear that people keep talking about. But I do find it very interesting because there's this almost desperation, I feel like, amongst the bear narrative right now to find another reason why this economy has to collapse. And the reality is there isn't a good one. So now I'm seeing this constant talk about, but Kevin, maybe the debt ceiling isn't the issue, but it's liquidity. Like, okay, all right, here we go. What's the next argument going to be? And it's fine. I'm not here to be perma bull. You know, somebody left me a comment the other day that easy for you to say you're just a perma bull. I'm like, no, I'm the dude in a Hello Kitty cup who's going to sit here and flip flop on you immediately and tell you about it immediately when poopy doopy hits the fan and it's time to flip flop. That's it. I'm not here to say I'm 100% perfect with my timing. I wish I originally sold earlier, like January 2022 was great. Wish I originally sold earlier. And maybe I wish I got into the market a little later. But I went from being completely out, one of the first finance YouTubers completely out, to basically being completely back in, before this sort of Nike swoosh recovery. And so the point is, obviously facts are going to change, and I'm looking every single day trying to study what's the next negative catalyst. And quite frankly, the biggest negative catalyst that I see is China for people who invested in China. I've regularly said I'm afraid of investing in China because I don't personally fully understand what's going on in the government there, and I'm not going to profess to. But I also understand that the consumer is a very different mindset because they need to have a different mindset. Remember during COVID when China got locked down for like 3 freaking years? Guess who got the stimulus money? It was businesses. It wasn't people in China. That's why people in China ended up getting somewhere around 1/12 the amount of stimulus money that we did here in America. It's remarkable. So, so back to this bearish, this idea. So inflation, which we have very few catalysts for suggesting that it's taking off again. The argument that bears like to make when it comes to suggesting, okay, well, we're definitely going to have more inflation, is this idea that it's going to be sticky, that inflation is just going to stay higher for longer, basically. And the historical context doesn't play well for the bears here because the Federal Reserve isn't in a position where they are required to get inflation down ridiculously quickly. There's no mandate that says, oh, we need to get inflation down to 2% immediately. That doesn't exist. Instead, the Federal Reserve can embark on something known as opportunistic disinflation, which is exactly what they did in the early 80s, through mid 80s, through the 90s, and the early 2000s, as long as inflation expectations remain anchored. And after this debt ceiling deal was reached, what did we get? Oh, look, inflation expectations rotating right back down again. You can see them here on the market's expectation of inflation. It's the 5-year break even. And we're at 2.14. We're not at the super lowest level we've been, but you could see the downtrend over the last year. If you zoom out, there you go. Pretty good downtrend. We've hit this lower area a few times. We're hitting some of the lowest levels now. This is really a way of saying inflation expectations have been anchored since September, which is phenomenal. Worst case scenario, you see a skyrocketing of inflation expectations here, kind of like what you did in February. But this was really due to January data coming in pretty hot, thanks to potentially a warm winter. Then you've got these year-over-year seasonal adjustments, a big mess sort of in February in terms of the data. But a lot of that ended up being nonsense. So yes, people are, but Kevin, it's not falling as fast as expected. That's fine, though. And that isn't necessarily to suggest that the Federal Reserve has to act in such a way that, they just continue their march up. We could sit here for longer, essentially. That's the higher for longer argument. Now, what the market is pricing in right now is a 25 basis point hike in June with a 56.1% probability. So you're basically at a coin toss for a June hike. Now, Jerome Powell has said we are at a sufficiently restrictive level of interest rates. Neil Kashkari, who turned into one of your hawks, which was crazy because during COVID, he was super like print. Anyway, so he's become a hawk, and he's under this impression like, I've been convinced that we could pause in June and maybe hike again in July if we need to. Anyway, market, despite all this, is pricing in a 50% chance of a pause here. Well, basically 56% chance of a hike, 44% chance of a pause in June. By July, interestingly, the market is pricing in a 22% chance of 2 hikes. And then you really don't get to a 1/3 cut, 1/3 hold, or 1/3 you're at 5.25, hold being 5, until January. Sorry, that's until December. And then you can pretty much confirm a cut by January. So anything 2023 is relatively uncertain for the market pricing in cuts as of the latest read, which is fascinating because that was actually another one of the bear arguments. Another bear argument was, but Kevin, as soon as the market starts pricing out these rate cuts that the market has been pricing in, well, then the market's going to crash. And it's fascinating because, once again, so far that has not been happening. And maybe it is just AI that's driving that. Maybe, who knows? But it's fascinating because if you look at the WIRP, the world interest rate probability, this is what you're looking at right now. You're looking at the peak rate being priced in here for July. And you're looking at being above 5% until basically December. That's what the market is pricing in right now. So all of a sudden, all of this, the first cut's coming in July or September or whatever, all of that has already been priced out of the market. And what has happened in the last few weeks? The market's done nothing but go straight up. And so it goes to show that interest rates really aren't the biggest driver of fears right now. So the biggest drivers of fear are a second wave of inflation, followed by a recession a fear. And this recession fear is probably more appropriate than even the inflation one, just because there are so few indications of inflation skyrocketing. And the recession one argues that, well, come Q3, Q4, companies and consumers are going to be in a position where everybody's just magically going to stop spending, and we're going to go into an earnings recession. And what I find remarkable about this is Nike had its earnings recession. Nike was the first company to have its earnings recession in 2022. The chip stocks had their earnings recession in Q3 to Q1. Look at their earnings, negative year-over-year earnings. The consumer staples are just now beginning their earnings recession. You look at Home Depot, you look at Lowe's, you look at Costco. The earnings recession wave has already been happening for a year now. And so this idea that, well, Kevin, we're going to go into an official recession. Okay, maybe. That is a risk factor. But then we have to ask ourselves, but does that necessarily mean all of a sudden the stock market collapses? And the question here is, well, that depends. What is inflation doing? See, if we go into a recession and inflation is soaring again and expectations of inflation have unanchored, we're screwed. Then we get Paul Volcker. Then I turn into a bear again and I have to flip-flop again. But if we are in a technical recession, much like Germany is right now, well, then all of a sudden you look and you go, okay, so Germany is in a technical recession. But remember what that actually means. And I think when we look at the basic concept of what a recession is, it's actually not that scary. Because think about this for a moment. If I told you, like, what would you prefer, okay? Would you rather grow like this, okay? Or would you prefer this kind of growth and then a little bit of this, and then you continue, okay? So obviously this one has substantially more growth than just sort of this example I made here. And I'm just being extreme, but the point of this is to say that, see this right here, that could technically be a recession because maybe you've gone negative for 2 quarters in a row. Now, it's fascinating because your growth is, you're your output is substantially higher than what it was previously. And what I think is so interesting is that as Germany is technically into a recession, and people are like, but Kevin, if we go into a recession, the stock market's going to plummet. Really? Okay, well, let's look at Germany's recession. You ready for what Germany's recession looks like? There's an index that's kind of like the Dow Jones in Germany. It's called the DAX. It consists of 40 German blue chip companies, okay? Do you want to see what recession looks like in Germany? Just Google DAX stock market. And what are you going to get? You're going to get all-time highs over the last year, baby. So wait a minute. Well, I thought if we go into a recession, the stock market was supposed to crash. And now this is the argument that as long as inflation is gone, nobody's going to give a crap if we go into a technical recession. Who gives a, Q3, Q4 recession? Look at Germany. Why does nobody care? Because there's no, there's no leading indicator that suggests we're going to see this massive second wave of inflation. If anything, a slight technical recession reiterates that we will. So then you really end up with the last big catalyst, which is policy. And this is just what's been so exhausting on the mainstream media is that, it's politics. Just wait. I'm already seeing it now. People going, but Kevin, there's an election coming up. That's just when you know we've run out of bad news. Now, again, I'm not saying we can't get more bad news. In fact, we've got quite a few catalysts coming up. Consider some of the catalysts coming up. The first big catalyst that you've got coming up is a price increase for all the courses on Building Your Wealth link down below, whether it's investing in real estate, investing in stocks. You learn everything that I know over my entire career about investing in real estate, getting wedge deals, building your net worth, buying below market value real estate, everything I know about stocks and psychology of money, and then everything I know about making more money, that is running a business, insurance, being an entrepreneur, or being an employee, how to get a promotion, how to make more money, how to be a model employee and provide more value. Like, how do we do that? And the AI lecture is coming soon. All of those courses get a price increase on June 1st at 11:59 p.m. So join before that. That's actually in like 2 days. So in 2 days, we have an expiration coming up. Keep in mind, there are various different courses. You can bundle them up. You can bundle them up on the website or email staff@meetkevin.com if you'd like to talk to us. And keep in mind, they all come with lifetime access to the course member live streams, which is pretty cool because every day the market is open right around the time the bell rings. We go through fundamental analysis on either real estate or stocks or whatever, and we chat, which is great. So check that out. All via the link down below. So now, yes, there are market catalysts as well. Like, for example, tomorrow morning, we're going to get the JOLTS, the Job Openings and Labor Turnover Survey. The last time we got surprised to the downside that these were starting to get absorbed. Tomorrow, we're expecting about 9.4 million job openings. We'll see what happens. This slips down more. It's a good sign that we're finally bringing the labor market back into balance and eliminates these fears about a wage price spiral. Tomorrow, you're also going to be getting, let's see here, we'll get a beige book from the Fed. That's going to be relatively boring. And then you're going to wait for about Thursday, which is June 1st, price increase day. You're going to be getting the ADP jobs report. That's actually going to be quite interesting. We're looking at 165,000 jobs. On Thursday as well, we'll get the ISM prices paid survey. And then we will also on Friday, we'll have a big catalyst. We'll have the jobs report coming out, which is fantastic. Jobs report will be a big deal. We're looking for average hourly earnings on a month-over-month basis, moving about 0.3%. And you're going to be looking for the change in private payrolls to be about 173,000, non-farm payrolls to be about 190,000. Then we're going to get some PMIs and ISM numbers. This is where we'll get these sort of individualistic reports on prices paid, which are relatively useful for understanding, okay, what are some leading indicators of inflation? So far, those leading indicators of inflation have been relatively soft. So I'm not going to go through all of these. Really, the next big catalyst you want to pay attention to is, of course, June 13th, which will be CPI day. We do have a forecast already. We are looking at, that's Oh my gosh, that'll be remarkable. We are looking at, first of all, the more basic part. Month over month CPI expected to come in at 0.3. We're looking for CPI core to come in at 0.4. Core 4, little sticky. But again, as long as inflation expectations are low, it's not actually a horrible thing, as long as things slowly start trending down and we start seeing that housing rollover as well as services rollover, and we're not seeing some kind of new liftoff. Year over year, though, we're looking at CPI coming in at going from 4.9 to 4.1, a massive drop. I mean, that's an 8-point drop right there on the CPI year over year. A lot of that, though, will have to do with energy, given that our core year over year will still be sitting at 5.3, but that will be good. The next day, you're going to have a PPI coming out, Producer Price Index, along with the Federal Reserve Open Market Committee expectation for either a rate hike or a pause. The present forecast by surveyors, even though the market is pricing in about a 56% chance of a 25 BP hike, economists are still pricing in a pause. So we'll see what happens from the Fed. But those are probably your catalysts here. And quite frankly, I'm just not seeing a big reason for massive volatility in these numbers. Obviously, we're going to report them. We're going to review them in detail. But I don't know. Maybe I'm just missing like the bear thesis, but it's just been very weak. I guess that's just the easiest way to put it. And I really don't think there's anybody who reads more earnings calls or economist letters or bear pieces from Goldman or Bank of America or Morgan Stanley than me, because that's just what I do. I sit around and I read this stuff all day long. I actually find it incredibly interesting. And the arguments have just been really weak. I mean, again, it goes back to sort of like when you start having the bears have to either lie about data or make up data, that's when I start going, really? Is there that little bearish news? And so sometimes I see that. And I've called it out on Twitter before as well when I see it or here on the channel. But again, if I get some bearish news, I'm happy to report it. But so far, I think, this is not the market to sit out on. In fact, I hate to say it, but I think this is quite potentially the greatest potential mispositioning that our generation will have ever seen, or I should say that people will have ever seen in a generation, since I know people of various generations watch me. I think this could be the greatest mispositioning. And I'm not here to like say somebody, did something wrong or whatever. Like everybody makes mistakes and everybody does things great, right? And your goal is just to do more things correctly and less things wrong. That's always everything any human could hope to do, is just to make less mistakes. That's everybody's goal. And I unfortunately really worry that the carrot of, oh, well, put all your money in, Robinhood 5%, Wealthfront 5.25%, so 5%, like all this noise has potentially created some of the biggest mispositioning in over a generation. And it'll be really remarkable to see what happens when and if we start getting that money flowing back into the economy. Think, for example, what the Wall Street Journal is suggesting. The Wall Street Journal suggests that what's driving the stock market right now isn't retail investors, because they're mostly positioned in mutual funds. That is at least what the Wall Street Journal says. It's actually just funds, like institutions, quant funds. There's a page on their homepage talking about this, and I was reading through it, and I'm like, my gosh, this is terrible for average Americans, who once again will get screwed, missing out. Now, I want you to know this: when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced